Okay, so in this first video, I'm just going to be giving you a bit of a rundown about what's happening in Australia at the moment, looking at some key factors that are impacting both demand and supply. Your exam is very likely to express or make you express your understanding of current factors that are affecting the Australian economy. So it's really important you're up to date with what are the key demand and supply side factors happening at the moment. So first thing, and this is probably the big thing that's been happening throughout the last 3 or 4 years, is the terms of trade is starting to fall. So the terms of trade measures the average price of our exports compared to our imports, and at the moment Australia's export prices are going down considerably, and that's driven by the fact that the mining boom is slowing down. So one of the big things that's happening in Australia at the moment is the terms of trade is falling. We're generating a lot less income from our exports because of the lower prices. That's leading to less consumption spending and leading to a lot more unemployment throughout the economy. So one of the big things, one of the big demand side factors at the moment is the fall in the terms of trade. And because the terms of trade is falling and we're not getting the same level of, same amount of money or income from our exports, the level of investment, particularly in the mining sector, is starting to fall. So during the peak of the mining boom back in 2012, 2013, mining investment was through the roof. Companies were making lots and lots of money selling minerals, so they were investing. They were building new infrastructure, building new machinery to try and get basically as many minerals as they possibly could out of the ground. Now we've basically finished the investment phase of the mining boom, and now the level of investment has fallen considerably, down to 4%. As you can see, it's still higher than what it was basically throughout all of the 60s, all the way to 2005, 2006. So mining investment is not low, it's just considerably lower than what it was at its peak, and therefore leading to less growth within Australia. Another thing, the Australian dollar, again this is related to the end of the mining boom. Because our commodity prices are falling and the value of exports is falling, the Australian dollar is falling, both compared to the US dollar and what we call the TWI. The TWI stands for the Trade Weighted Index, which basically measures the purchasing power of our dollar compared to some of the major trading partners around the world. So at the moment, the Australian dollar has fallen to, it's about 77 cents, so it's actually picked up a little bit since this graph, and it's about 65 on the Trade Weighted Index. Now that's good because it's making our exports more competitive because it's cheaper for people overseas, but it's also making imports a lot more expensive. Non-mining investment, as I told you last video, mining investment has gone down considerably, the blue line, sorry, but the red line, non-mining investment, is quite slow at the moment. Investment in manufacturing is quite low because we can't compete with low-wage countries, and overall, the idea with the non-mining investment would increase once mining investment slowed down, but it's not really the case. The labour market. So looking at the labour market, the unemployment rate is considerably higher than it has been throughout 2012, 2013. Unemployment rate at the moment is about 5.8%, which is above our target range. We don't really want it to be above 5%. So that's negative and a sign of a loose or a weak labour market. Although the overall level of employment is still growing, and that's to do with the fact that our labour force is bigger. So there's a lot more people that are employed at the moment, but there's also a lot more people that are unemployed, purely based on the fact that our total labour force is bigger. And we'll discuss that a little bit more next chapter. Job vacancies. Job vacancies, it's really important. The higher the job vacancies, the stronger the labour market. And the more advertisements, the stronger the labour market. Because if there's a lot of job vacancies, it basically means people are looking for workers, and people will look for workers when they have a lot of demand for their products. So when job vacancies are high, it's a sign there's a lot of demand for labour. When job vacancies start to fall, it's a sign that there's less demand for labour. And job vacancies are still quite low within Australia, and so are job advertisements, but they are starting to pick up a little bit at the start of 2016, so that's a good sign. It shows that employees are looking to hire people. Household savings ratio starting to fall a little bit. It's still much higher than it was before the GFC because people want to save more because they're not as optimistic. Consumer confidence is lower, but it is starting to lower, as you can see, over the last sort of 5 to 6 months, based on the fact that consumer confidence is starting to grow again. Okay, one of the big things at the moment is where is the new jobs coming from in Australia, and most of it's to do with the professional sector, science, and education and healthcare are sort of the main big growth industries. Obviously, an ageing population means a lot more demand for healthcare, but education is one of the big things, and that's driven on the back of the lower Australian dollar. Other industries like manufacturing, employment growth is falling, mining falling considerably, retail still falling, and agriculture. There's a lot less employment, and part of that would be to do with us becoming more capital intensive. Okay, and another supply side factor that's happening at the moment is that wage inflation is remarkably low. These blue lines represent the average increase in wages over the last decade, okay, and you can see they're sort of in the range of 3 to 4%. But basically, in all industries, wage growth in 2015 was below 3%. So wage growth is growing at a much slower rate than it has over the last 10 years, and that's indicative of a looser labour market and weak labour market conditions. Unit labour costs, because wages aren't increasing by much, unit labour costs are also slow, and we'll discuss a little bit more about what unit labour costs mean throughout this chapter. But basically what's happening is unit labour costs are starting to fall, or sort of around zero. Okay, during this range here, unit labour costs are growing by a little bit, but you can see in 2015 unit labour costs are starting to fall. And basically that means that productivity is increasing at a faster rate than average earnings per hour. So to sum up where we're at the moment, the current account is really high at the moment, and that's due to do with our lack of export income that we're receiving at the moment, and we'll discuss that a little bit later. I'm not going to go into detail about the current account. Unemployment is still above where we'd like it to be. There's slow wage growth. China's starting to slow down, and that's reducing demand for our commodities. The mining investment boom has ended. The cash rate is very low, so the interest rates in Australia are quite low, and that's increasing demand for housing. The exchange rate is falling and may fall even more towards the end of this year, and that's to do with the fact that our minerals are not selling in the same quantities that they have in the past or at the same price. It's mainly to do with the price. And we're likely to experience a decade of budget deficits because growth is too slow, and I'll link that a little bit more in the next video. Thanks for listening.